So today's Cardinal lesson, we're talking about the 10 principles of investing success. So these are the principles that Tom and I use when we're managing clients' money, when we're taking the money under management and we're investing it for the future. Okay. So we're going to go over these 10 principles, and these were brought to us by a fund company that we use quite a bit, which is Dimensional. And so let's just kind of jump right in. Number one is embracing market pricing. So, what this means to me is there's $774 billion in 2021 on an average day globally. $774 billion in stocks are traded by the market. There's buyers and sellers every single day of the year. And what we mean by embrace market pricing is that you just accept it. So I want to bring Tom on, and I want Tom to just talk a little bit about what number one means here.
Yeah. And so, what the market pricing is you have a buyer and a seller. They're coming together and they're agreeing upon a price of what they're going to trade this stock for example. And then our belief and really what we follow here is that is very efficient, is that is the best way to know what something is worth as the market comes together. There's a lot of money that's trading hands. And so it's being priced in very quickly. And so we want to embrace that, is not try to go against it. It's just that's what it is. That's what the pricing is on there.
So number two is don't try to outguess the market. I mean, it really ties in with number one is while this market is going on, it's going on right now. And all over the world, buyers and sellers are trading. And so don't you try to sit down and say, "Oh, I know better. This thing's underpriced. This one's overpriced." I mean, the market is there. And then as you pick a fund manager or an advisor, put themselves in a position where they think they know better. What we're saying is we don't know better. We don't try to outguess the market.
Yeah, and I think, and we'll get into the show notes in a second, but there's data that's showing over like a 20-year period, only 18% of the equity fund managers, these are people who do it professionally, outperform the market. So when we have individual investors thinking that they can do this better than the professionals, I think it's maybe unwise to take that approach that you think you're smarter than people who do this. And then the people who do it professionally, only 18% of them can outperform. Once you start factoring in the fees that they charge for it, generally it's about the same as what the market's going to do.
Yeah, Tom, why don't you bring up the show notes and let's show them the document so you can refer to later if you want a little more detail on these 10 points.
Yeah. And so these show notes are in the link below of our video. They're also on our website. I go to our website frequently to get the stuff that we use on our notes just in our practice, but it's very helpful. I'm going to go through fairly quickly just so you can see them. A lot of the main points are on the board, so we're going to focus on the board. But if you want more information, they are here in the show notes. I'll make it a little bit bigger. But again, we have the numbers, the different pieces. We'll go through each one as we go through the board. But this is where you can really get some more detailed information, something backing up the stuff that we're talking about kind of on the video here. There's a bunch of disclosures down at the bottom, obviously.
Yeah,
So
and the whole point of this presentation is we embrace as we practice day to day all 10 of these things. I mean, all of them together. So it's the body of work. So we're going through these fairly quickly. So we want number three is resist chasing past performance. We see this a lot is just because something or a fund or an individual security has performed well in the past and their performance and their track record looks good, that isn't necessarily the sole reason to buy something.
yeah, I mean, I think there's data there, and the data is looking at mutual funds, ETFs, things that have a broad diversification. But if you look at the funds that over like a 5-year period were in the top quartile, they've done the best. The next 5 years, only like 20% of them stayed in that top quartile. So looking at past performance to try to predict future performance, and you'll see this on all investment stuff that you ever see, is it will have a statement down at the bottom. Past performance is no indication of future results. And this just speaks to that, is that looking at what it's done previously is not necessarily what it's going to do in the future. Making your decision solely on that is not a great idea.
Okay, so consider the drivers of returns, and there's different drivers for stocks or equities, and there's different drivers for bonds.
Yeah. And so, again, this is the data that Dimensional has put together, and they have a lot of academics who have done a lot of research on this. But if we focus on the equity side of things, what they have shown in their research and in their studies is that there are three drivers of performance in the equities that tend to show up across time frames, across geographically, internationally. It shows up there. So there's a lot of data that has shown this works. Again, it's not necessarily saying it's always going to work in the future, but what they have shown is that company size matters, relative pricing matters, and then profitability. So the data shows that small caps over time tend to outperform large cap stocks. Value tends to outperform growth stocks again over time, not necessarily in a short window. And then high profitability stocks tend to outperform low profitability. Again, there's more data there. If you're interested in learning more about that, call us. We can have a further discussion on that. But that is, we believe that that is part of our investment philosophy. And so we tilt our portfolios, not going all in on those factors, but tilt it more towards those to try to gain a little bit more performance within those funds.
Okay, so number 6, practice smart diversification. Get many market segments and diverse globally.
Yeah, and I think one thing that we often see is people will come in and they'll have, they're investing themselves or they have someone else investing and they might have, I don't know, 50 different investments and they say I'm diversified. I have a lot of different companies. But when you really look at the data, all these companies or all these positions, they move in the same direction. When one is up, they're all up. When one is down, they're all down. That's not really diversification. That's just holding a bunch of different positions. And so true diversification is having things that don't move in sync with each other. When one is up, one might be down. When one's down, one is up. You want that different mix of things, and it needs to be globally. It's not just here in the U.S. We're of the opinion that you should widen your investment approach, and not saying that it needs to be evenly distributed, but having some international exposure, having exposure to different parts of the economy, some tech, some financials, some retail, whatever it might be. Getting a broad diversification across sectors, across globally, is tends to work out over time.
So, number 7, avoid market timing. Which segments outperform year to year? It's going back to what we've been saying all along. Is a lot of people are doing this right now, where they've been on the bad side of market timing. I mean, they're wanting to sell now, and the only people that we're going along with that, if you're going to sell, you're going to get out permanently. That's understandable, especially if you've made money over time. But it really, now you could make an argument, is the time to be looking at buying when we've just suffered a severe decline because, or a dip. So, Tom?
Yeah, I mean, I think, and there's a lot of different ways to approach this, but again, it's this sort of is relative, related to a lot of the other points we've talked about on the show, is trying to time the market and maybe trying to pick which sector of the market's going to do well the next year is really hard to do. I mean, it's, when one year there might be a certain area that does really well, the next year it might be down and there's another area that does well. And so again, that speaks to having a diversified portfolio. It speaks to trying to not to pick and choose which one you're going to invest in, and just sort of stick to a plan, get invested appropriately from the start, and stick to that over time. Rebalancing as you go to stick to the overall plan we're looking at is the better approach, in our opinion, to investing, as opposed to trying to time which one's going to do well, this next year.
Number 8 here is big. Yeah, this even goes for us too, is manage your emotions. I mean, what I'm talking about is acknowledging the optimism that's there when it's there. Is, things are going to go way up, I'm going to make a lot of money, and then the elation that happens after you've had a period of time where your stocks have increased greatly. Acknowledging the nervousness after we have a year like last year, um, and then the fear, which is really present a lot today is to acknowledge all of that. And then this is where we remind our clients to go back to the financial plan that they created with us, or we wrote the thing, but we created it with them. And the financial plan is there for the long term. I mean, it's just, we have people coming to us at retirement or anticipating retirement, and it's time to redo the financial plan. And then when we get to a point where we've had some bad performance or we've had a dip and all of this stuff becomes ever present, people call us up and they're going to say sell everything. Well, we got to follow that if that's the orders we get, but we try to take them back to the financial plan and we point out to them that this was accounted for.
Yeah, I mean, I think this is really the hardest thing that people. It's easy to say and practice. Oh, I can manage my emotions. I'm a disciplined investor. I'm not going to worry about the ups and downs until it happens. Especially in the clientele that we're dealing with a lot of times is they're approaching retirement. They might have just retired, and they're looking at this. They don't have a paycheck coming in. They're having to live off this money, and it feels different this time than it did back in say 2008 or any previous decline that they've been through. And so even though they might say with their words, I'm okay with the risk I'm taking, I'm okay with this, in practice, and it bears itself out when we see a decline and they're calling us up freaking out. It's like clearly they were taking too much risk. And even though they told us they're okay with that, in practice they weren't. And so this is where that plan is really helpful, creating this plan where we can stick to it. Because the worst thing you can do is sell right as it went down and then it recovers. You missed it going up, you buy back in, then it goes down again, and then you sell. I mean, it's a cycle that's really problematic and can be very detrimental to your long term success. And so trying to manage those emotions, getting invested appropriately on the front end and being able to stick to this long-term plan is a much better way to go about it than having to, worry about and this gets to the next point, but like the headlines of the day, what should we do now? And that's, we want to take a long-term approach to the investing.
I mean, I read the headlines and the articles under the headlines every day, and I'm on those. I don't turn my back on these, but I don't go act on them. And I don't call my clients up and start acting on those things. We're going to go back to the financial plan and either revise that and then act, or we're just going to go back to the financial plan, point out what this is, and that the financial plan accounted for some dips, and just kind of look on the tracks of where we are. So it's really looking beyond the headlines, like the SVB crisis that's going on right while we're making this video, the war, the recession, the economy. I mean, you need to pay attention to these things, but you don't need to get in a state of fear or a state of optimism and then start making emotional decisions about your investments.
And I will make the point out that that is assuming that are in the right investment mix from the start. We've done this plan, we've got you invested appropriately. We have a lot of people come in that are not invested appropriately. They maybe are taking way too much risk. And it might be appropriate to change the things, but that needs to be in the context of an overall plan, not just based solely off of the headlines. So the headlines can be, a catalyst to talk to us potentially, where we come up with the plan. But once the plan is in place, we're not going to focus on the headlines and we're not going to veer from the plan, because in the plan we've accounted for the possibility of these ups and downs in the short term.
Yeah. So it's number 10 is focus on what you can control. Okay. And that's what we focus on as we're managing our clients' money to the financial plans that we've created together.
Yeah, I mean, I think there are things you can control. We can control how much risk you're taking in your portfolio. We can control taxes. We can control expenses in the funds. We can control the diversification there. We can't control what the market's doing. I mean, we are not in control of what's going to go up and what's going to go down. And so that's where we want to get into a plan, have it be a long-term plan, have it be invested appropriately for you specifically. And that's different from client to client. And then that allows you to control what you can, not have to worry about what you can't, and know that it's part of this larger plan that you're going to be okay.
Well, yeah, and sometimes when people come to us at retirement, they are invested too aggressively, and it's paid off for them, and then they've lived the downside of that, like last year, and now they're coming in, and it's appropriate to take some of the money off the table and get into something that can give them a guaranteed income stream that they don't have to worry about. So, I mean, that all gets back to the financial planning. That's not the investment planning. So, I want to go through and I want to just go through these 10 things really quickly because it's the body of them that really make up how we think and how we act. And really, that clients can use these things to decide whether they want us managing their money. I mean, embracing market pricing. We don't try to outguess the market. We don't chase past performance. We let the markets work for us and our clients. We consider the drivers of returns and the academic research on each individual security and each fund. Um, we practice smart diversification and real diversification. We avoid market timing. We don't try to get in and out at certain times based on what we think the market's going to do. We help our clients manage their own emotions, and we act as a stable force that has written a financial plan with them, and we going to remind them of that. We look beyond the headlines, so that doesn't mean we don't look at the headlines, but we look beyond there to and back to the financial plan, and we focus on what we can control. So, what I want to do is just go over what of the 7 things or the 7 worries of financial planning that we're doing for seniors, for retired people, have we touched on today. And really, it's been IRA, 401k. That's where a lot of the money that we're investing for people is. It's focused on income and it's focused on taxes because that's a big part of our investment planning is to try to get people in the right place tax wise. So I want to bring Tom back on and I want to thank you very much for listening.
Thank you.